If you're self-employed and you're looking to buy or refinance, here's what you need to know about mortgage financing. For your income to be deemed eligible, you typically need to have 2 years of history. And this is documented via federal tax returns. So you need to provide both your personal and your business tax returns. Your self-employment income may appear under your Schedule C or Schedule E. These fall under your 1040s, your personal returns. If you have a partnership, that would be the 1065, or an S Corp, that would be the 1120. In addition to tax returns, you often need to provide a year-to-date profit and loss statement and or a balance sheet. Third-party documentation is typically required, such as a business license, a CPA letter, or an internet listing to show the business is active. Whatever documentation you submitted to the state where the business is located to set the business up, typically the articles of organization or articles of incorporation. If you are paid as salary by the business, your W-2s. If you are paid as an independent contractor, you'll receive 1099s and you'll want to provide those. If you're planning to use any of your business assets towards a transaction, a cash flow analysis by underwriting is typically required. If any monthly debt is paid by the business, to exclude from the debt ratio, you typically need to provide 12 months of documentation to show the business is paying for the debt. If you have less than 2 years of self-employment history, you may still be eligible if you have at least 1 year of business tax returns and a prior history in the same line of work. A great example of this would be a truck driver who worked for several years as a W-2 employee for a company. They saved up enough money, bought their own truck. They're now an independent owner-operator, being paid as a 1099 independent contractor for that same company. With 1 year business returns and W-2s for the prior history, they could be eligible for financing. If you cannot document self-employed income via traditional methods, the options for financing include bank statement programs, profit and loss statement, 1099 programs. These all fall under non-QM, non-qualified mortgage programs. The bank statement program by far is the most popular with the self-employed. Anywhere from 12 months to 24 months, statements can be submitted. The income used is typically 50% of the deposits going into the business bank account. Up to 75% can be used if the expense ratio for the business can be documented. And this can come via a letter from the CPA. So if you have any questions about mortgage financing for the self-employed, just click my link tree.